Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MANNKIND CORP quarterly report. MANNKIND Corporation offers a range of therapeutic products and services for endocrine and orphan lung diseases in the United States. The company's portfolio includes Afrezza inhalation powder, an inhaled insulin for diabetes management, Vigo wearable insulin delivery device, continuous subcutaneous infusion of insulin Tyvaso DPI, treatment of pulmonary arterial hypertension and pulmonary hypertension. The company also has a pipeline of products in development, including MNKD-101, nebulized clofazimine for severe chronic and recurrent pulmonary infections, MNKD-201, dry powder nintedanib for idiopathic pulmonary fibrosis, IPF, MNKD-301, treatment for cystic fibrosis, preclinical stage. Additionally, MANNKIND has partnerships with various companies to develop and commercialize its products, including United Therapeutics Corporation Thyrna Biomas, Brazil Cipla Limited, India Amphistar co-promotion of Baqsimi nasal powder. MANNKIND Corporation's stock price drop. A year of challenges in the past year, MANNKIND Corporation's stock price has plummeted by over -18.55%, with several key events contributing to this decline. One significant factor was the company's Q2 2025 revenue miss, where it reported earnings that met profit expectations but fell short of revenue forecasts. This led to a 12% drop in shares. The stock also hit a 52-week low on two occasions, June 10, 2025, and July 1, 2025. The first instance was partly attributed to a negative earnings report showing unexpected operating losses, lower than expected revenues, and rising operational costs. The second instance occurred within the context of a challenging year for the company's stock performance. Furthermore, MANNKIND's Q2 2025 earnings report showed robust revenue but a slight miss on EPS, which contributed to the decline in shares. Additionally, the announcement that Chief Medical Officer Burkhard Blank would step down by August 2025 added to the uncertainty and negatively impacted investor confidence. These events collectively led to a significant drop in MANNKIND's stock price over the past year. The primary drivers of revenue growth or decline for a company are multifaceted and can be categorized into several key areas: business operations, regulatory environment, market and competition, financial and economic factors, employee and management, taxation and accounting, and general business risks all play a significant role. Key drivers of revenue growth include effective commercialization efforts, successful product development, and compliance with regulatory requirements. Conversely, limited commercial success, manufacturing risks, and supply chain disruptions can lead to revenue decline. Additionally, changes in tax laws, regulatory delays, and market acceptance among key stakeholders can also impact revenue growth or decline. The ability to navigate these various factors is crucial for a company's long-term success. By understanding the primary drivers of revenue growth or decline, companies can develop strategies to mitigate risks and capitalize on opportunities, ultimately driving sustainable revenue growth. Net income and profit margins. A decline amidst challenges. The company's net income and profit margins have undergone significant changes over the past year. In Q3 2025, net income decreased by 30% compared to Q3 2024, dropping from $11,550 to $7,985. However, on a year-to-date basis, net income increased by 8%, rising from $1.645 million in YTD 2024 to YTD 2025. Profit margins have also declined across the board. Gross margin decreased from 58.1% to 54.6%, while operating and net income margins dropped from 18.2% to 9.3% and 16.5% to 10%, respectively. Several factors contributed to these declines, including non-cash adjustments, manufacturing risks, potential government regulations, and reduced U.S. drug prices. The implementation of most favored nation pricing has also had a negative impact on profit margins. These challenges have resulted in decreased net income and profit margins, highlighting the need for the company to adapt and mitigate these risks to maintain its financial stability. The company is indeed generating positive operating cash flow, as evident from multiple sources. According to financial reports, net cash provided by operating activities for 2024 was $26,213, page 16. Additionally, the company generated $19.9 million of cash from operating activities for the 9 months ended September 30, 2024, page 58, and it is confirmed that positive operating cash flow was achieved in the year ended December 31, 2024, page 70. This consistent trend indicates a stable financial performance. The company's financial situation has undergone significant changes between 2024 and 2025. While the total debt has increased due to borrowing $250 million in delayed draw term loans, the overall debt level has actually decreased by $29,339. This seeming contradiction can be attributed to the increase in liability for sale of future royalties being offset by a decrease in interest expenses on this liability. Notably, interest expenses have seen a substantial decline, with a 24% drop for the 3 months ended September 30, 2025, and a 40% decrease for the 9 months ended September 30, 2025. This reduction in interest expenses suggests that the company has managed to optimize its debt obligations or negotiate more favorable loan terms. Overall, while the debt level appears to have increased due to borrowing, the significant decrease in interest expenses indicates that the company's financial situation is not as dire as it initially seems. The financial performance of various segments and regions within the company has been mixed. The Afrezza, collaborations and services, and royalty segments have underperformed, with declining revenues over the past 3 months and 9 months. In contrast, the Vigo segment has shown growth in revenue over the same period. On a regional level, the Danbury, Connecticut facility has performed well, while contract manufacturers in China pose a potential risk due to tariffs. The endocrine business unit has also exceeded its targets for net sales in Q3 2025 and Q2 2026. Management is optimistic about the company's short-term prospects, expecting to meet near-term liquidity needs and having sufficient resources to fund operations for at least 12 months. However, they are cautious about the long-term strategy, citing uncertainty in product development timelines and costs, limited financial resources, and risks of unforeseen events delaying commercialization. The company plans to continue investing in its pipeline and developing patient-centric therapies for cardiometabolic and orphan lung diseases. Acquisitions and divestitures overview. In recent years, the company has undergone significant changes through strategic acquisitions and divestitures. 2 notable acquisitions include Vigo from Zealand Pharma, a/S, and Zealand Pharma US, Inc. in May 2022, which aimed to enhance the company's product offerings. Additionally, SC Pharmaceuticals Inc., SC Pharma, was acquired in October 2025, further expanding its capabilities. On the other hand, the company has also divested certain assets to optimize its portfolio and reduce liabilities. A notable example is the sale of a portion of royalty rights in December 2023, which resulted in a liability for future royalties. These transactions demonstrate the company's commitment to strategic growth and optimization. The company's financial summary reveals that it has undergone significant changes in its capital structure. Specifically, the company has exchanged debt for equity securities and senior convertible notes for common stock. However, there is no indication that the company has bought back existing shares or paid dividends to shareholders. These transactions suggest a focus on restructuring the company's balance sheet rather than returning value to investors through share repurchases or dividend payments. And concerns about inventory buildup or supply chain disruption. The company's financial summary reveals significant concerns regarding inventory buildup and supply chain disruption. Notable indicators include a substantial increase in inventory write-offs from $1,909 in 2023 to $8,335 in 2024, indicating potential overstocking issues. Page 16. The cost of goods sold has also seen an upward trend, with commercial costs increasing by $1,301 from Q3 2024 to Q3 2025, page 20. Furthermore, the company acknowledges inventory buildup on page 21 and recognizes losses on purchase commitments totaling $66 million and $58.2 million, pages 45 and 57. The impact of supply chain disruptions is also evident, with concerns arising from changes in tariff policy by the U.S. government, page 49, dependence on contract manufacturers in China for Vigo products, page 65, and potential delays in clinical trials due to trade restrictions affecting import of materials necessary for trials, page 65. Additionally, quarantines and lockdowns affecting third-party manufacturing facilities in the U.S. and China have also been identified as a supply chain disruption risk, page 71. These concerns highlight the need for the company to reassess its inventory management strategies and mitigate potential risks associated with supply chain disruptions. That concludes the financial summary for MANNKIND CORP. Feel free to comment below, and I will be happy to answer them when possible.